backed by popular demand. 3 stocks near 52-week lows. One just reported yesterday. Which one? Boeing. Guys, Boeing is down 1.5% today. In fairness, the market overall is down, but they reported earnings yesterday and revenue. $16.5 billion reported revenue versus an estimate of $16.23. So they beat on that, but revenue is still down about 8%. They announced a $1.13 loss, but they were expected to lose $1.76. So less loss, that's awesome. Guys, deliveries are down 36% though. They only delivered 83 planes in the first quarter versus 130 in the same quarter last year. Things are not great with Boeing right now. So let me show you guys a little bit of an interesting history of Boeing. This is Boeing versus Airbus in terms of their orders. You know, pretty much in line. Look at this all here. And then look at this. Airbus has absolutely skyrocketed versus Boeing. So Airbus is taking advantage of Boeing's bad reputation right now. You know, basically right now there was an account I follow. I think it's called Babylon Bee on Instagram and Twitter. And the joke was that now flight attendants are announcing to people in the unlikely event of a safe landing for Boeing planes. And I just thought that was funny because there's been so much negativity around Boeing planes and safety. And guys, I'll be honest with you. I don't know if it's just we don't hear about those things all the time versus if it's what the reality is. But the bottom line is Boeing has a rep problem since 2020, essentially. So let's check out a few more stats on Boeing. Look at this. This is Boeing's revenue going back. Now, obviously, $101 billion fell to $58 billion in 2020, but it's climbing back up here. 2022, they did $66.6 billion. Let's see what they did in 2023. So we're going to the income statement. Wow, big jump to $77.8 billion from that 66.6. So revenue is coming back here. Now, Boeing is a prime example of a company that if you think this is just a short-term problem, do you start buying it? Maybe so. That's the interesting part. But keep in mind, guys, Boeing is not off its multi-year low. Back here is at 120. Back in September of 2021, it hit a low about 121. All right, that's a lot lower than it is today. Remember, it's still at 166 today. And its all-time high of 446 back in March of 2019. March of 2019. But in 2019, they did revenue of $76 billion. But in 18, they did $101 billion. So in between these two parts is when their stocks started to fall. Makes sense. Revenue fell, stock fell, etc. Okay? Remember, COVID wasn't until here. A lot of issues there on that one. Now, here's Boeing's gross profit margin going back to 1990. Now, remember, gross profit margin is on that unit they sell. They take out all the direct costs. What do they make on that plane? What percent do they make on that plane? If you look at history before 2020, 2019, they were pretty much in the high teens level, right? For a long period of time, from 2000 to 2020. Well, then over here in 2020, they fell to a negative 10% and been climbing back up. All right, so it's not quite, they're at 10% as of right now, not quite to where they need to go, but that shows a lot of potential for driving that profit. And if you remember, I invested in Disney, I invested in Southwest Airlines. I do believe the gross margins and the bottom line margins are a temporary problem. That's the question about Boeing. Is this a temporary problem that you can overcome? So let's check out more on Boeing here. Let's see what the 8 pillars show, because this is going to be ugly, I'm sure. Yeah, 5 X's, 3 checks. Obviously, when they've had such a struggle for a while, their 5-year net income is up, their 5-year free cash flow is up, $12.7 billion, and their revenue growth is up. Everything else is bad. Everything else is bad. They still have negative free cash flow. They're still struggling here right now. Again, is there potential? Let's see what analysts are saying about Boeing. Earnings per share. Look at this. $3.84 per share to $15.70 per share here in the next 4 years. That's almost 5x. That's 4.5 times profit. Let's look at their revenue growth. Analysts are expecting big-time revenue growth, $92 billion this year, up to $135 billion in the next 4 years. Now, obviously, we don't know what's going to happen. Are there going to be more issues with airplanes? Are they going to have more problems? Are they going to lose more to Airbus? Is Airbus going to take them over and permanently impair the business? I don't know. It seems hard to think that Boeing would go away, but we really don't know what's going to happen with it. But that's what we're trying to do here as investors. What we're trying to do is pick companies that might have a temporary problem and the perception's bad and sit there and say, okay, is there an opportunity here? The stock was at $400 and some just 5 years ago. Now it's at 160. I think the low during COVID was like $82 or something like that. Is there a temporary problem here? Can we sit there and attach the fundamentals and say, what's this company look like in the long run after they get through these problems? And then from there, can we stomach the emotions of what's going to happen in the short run? That's what proper investing is about. Proper investing is about making the right fundamental decisions and then holding on for a long period of time. So let's continue going here on Boeing, because I think the stock analyzer tool might be a little bit harder on this company. But let's see what I did the last time I did Boeing. Let's pull it up by name. I haven't done it since 2022. Okay. So I did a 10-year analysis. For revenue growth, low, middle, and high, I did 6, 9, and 12%. That was back in 2022. Things have gotten better since then. So maybe I go a little bit lower here. Maybe I go 4, 7, and 10% revenue growth. That would double revenue on my middle assumption in the next 10 years. They did 77. Okay, that seems 150 billion. They were doing analysts expect 135 in the next 4 years. That seems pretty reasonable. Bottom line profit margin. Remember, their gross profit margin right now is extremely low. Bottom line profit margin, the issue we have is this. Go back 10 years, we have a problem here. There's not much. 1.1% profit margin, 2.5% free cash flow. So you know what I'm going to do, guys? I'm going to go to the income statement. And when they were more stabilized, what was their profit margin? Well, back in 2014, they did 90 billion in revenue and 5.5 billion in net income. That's about 6%. The next year, 96 billion in revenue, 5.2. Again, about 5.5%. 2016, 93 billion, 5 billion in revenue. Profit, I mean. 94 billion, $8 billion. So really, their profit margin isn't as great as we thought. I think I'm going to change this number here. From 6, 8, and 10, I'm going to go with 4, 6, and 8. Because it looks like 6% is about where they should be based on the few years that they were growing their revenue and profit. Could be wrong. Could be 5, 7, 9. We don't really know, but these are the estimations. Now for PE, I did 13, 15, and 17. I'm actually going to do this. I'm going to do 15, 17, and 19. Because I believe that Boeing, it's going to be hard to take over. I think Boeing, even if Airbus overtakes them as the number one manufacturer, or maybe they already are, I look at it going, it's still Boeing. And I would be reasonably surprised if Boeing wasn't around in 5 or 10 years. I think the two major manufacturers of airplanes, Boeing, Airbus. Okay, so I'm okay putting 15, 17, and 19 here. Now for desired return, let's do 9% like I've done lately. And the reason being is this is no margin of safety. Guys, you need a margin of safety for Boeing. We don't know what's going to happen. But I just want to see if these assumptions play out. Are we even in the realm of possibility? When I look at a company, when it comes to the fundamentals I look at the 8 pillars and it tells me a story. When I see $12.7 billion in cash flow growth, I go, oh my God, this is interesting. Well, yeah, because their cash flow sucked 5 years ago. But here I look at this saying 9% desired return. This is the market. Now remember, there's no reason to buy an individual stock if you only want to get the market return. You got to get some sort of premium. But this is a starting point to say, this is what it's probably worth. Should I go deeper? That's the big key here. Now, guys, the reason the software was created is because it married both the fundamentals and the emotion. I use this tools, I use the 8 pillars, I use the stock analyzer tool to help me with my fundamental approach. But then I use the community here on the emotional side. We've all been there where we see a stock go against us. And the story goes again. Remember, news follows the stock price. So when the stock starts to fall, the news gets negative. Are you able to control that? Are you able to control the sensation and be different from the crowd? That's what makes investing so difficult, but that's what makes great investors. And that's why I wanted the community to sit there and support each other to become better investors. Because if you're able to do that, you're really going to be able to generate a lot more return. So if that sounds interesting to you, if you're sick of making emotional decisions that cost you money and want to decrease that, click the link below, sign up for the community. It's only $7 for 7 days in order for you to try it out. But most importantly, we have a waitlist starting soon. So sign up now before the waitlist starts. Avoid that waitlist. So sign up now. I'm going to hit the analyze button. So based on no margin of safety, interesting. I have 82 on the low side, 300 on the high side, 167 in the middle. So to me right now, not much margin of safety, but is it something to pay attention to? Absolutely. Now, how much margin of safety do you need? Guys, I'm going to add it to my watch list. I'm not desperate to own this company. I'm going to put it at 120, not as a point to buy, but as a point to do a deeper dive into it. That's the big key there. But just to be clear, let's put some margin of safety in here. The lower our assumptions, the less margin of safety we need. Okay, so I'm going to put in here 11, 13, and 15%. 11, 12, and 13%. Analyze. So look at it right here. 72 on the low side, 223 on the high side, 135 in the middle. So my 120 is really factoring in much higher than the 12% margin of safety. And I'm okay with that because I'm not desperate to own Boeing. It's a highly capital intensive business. Stock number 2, Johnson & Johnson. Jeff Johnson, Eddie Murphy. Okay, Johnson & Johnson. Guys, there's some great information on Johnson & Johnson. These are the top pharmaceutical companies. The dark line is their R&D. The blue line is their pharma sales. Look at Johnson & Johnson, number 3 in the world. $14.4 billion in research and development, which is, I believe, the highest. Nope, one higher. Roche in Switzerland. And pharma sales, $50 billion. I love the fact that they're spending a lot of money on R&D. Okay, even more than Pfizer, over double AbbVie. I mean, when it comes to pharmaceutical, you really got to look at that pipeline. That's really, really important. But Johnson & Johnson does more than just pharmaceuticals. That's what's great about them. They have everyday products as well. But this is a great company to take a look at. So let's pull it up and let's take a look here. Well, one thing that's attractive, 3.3% dividend yield, but it eats up $11.8 billion of their free cash flow. Last year's free cash flow was $17.8 billion. The last 5-year average was about $19 billion. Okay, now, one thing that's kind of poopy, net income last year was $35 billion, and their free cash flow was 17.8. That is too big of a difference. But their 5-year average net income was 21 billion versus 19. So it tells me there's just something in here that was a short-term issue. It wasn't like it was a long-term thing because the 5-year average is pretty close to each other, right? They're within 5% of each other. We're good, 7%, okay? Now, gross margin, 68%. Every extra unit they sell, 68 cents of that, can go to the bottom line if overhead stays the same and after paying taxes. Bottom line profit, 24% over the last 5 years. And again, profit margin's big last year. Now the revenue growth rates over the last 3, 5, and 10 years, 1.9, 3.1, 2.5. It's not a grower. It's not a grower, guys. The question is it a shower? That was terrible. Sorry, guys. Let's check out the 8 pillars here. Now I'm actually surprised by this. The 8 pillars here, kind of surprising. We got 7 checks. The one down, $2.14 billion decrease in free cash flow. Ignore this net income, though, because we sat there and saw that there was probably some... Let's go see what that was. Let's go to the income statement. What caused this big jump? So I'm looking for these interesting... Wow, they actually had a special income charge of 7 other income expenses. Income from discontinued operations. Boom, $21 billion. $21 billion one time. You got to remove that. So really, it takes their net income down to 14, which is still pretty decent, with some write-offs in there, other income expenses that were big. Okay, that's pretty interesting. Let's see what analyst estimates are. Earnings per share, not very much growth. Low single digits, low to middle single digits, 7.7, 4.3, 3, 3.5, 5.6. And revenue growth, inflation, 4, 3, 3.5, 3.5, 2.7. Okay. So again, it's important to understand that I would be surprised if Johnson & Johnson was not around 10 years from now, but you can't go pay through the nose for it. So let's sit there and look. What's the right price for Johnson & Johnson? Jeff Johnson. I just love saying Jeff Johnson. We did Johnson & Johnson. And guys, here are my revenue growth numbers, 2, 3, and 4%. Profit, 18, 21, and 24. And the reason I did that was, remember, it was skewed this year in 21 and 24% over the last 4, 5, or 10 years. Free cash flow, 19, 22, and 25, because free cash flow was a little bit higher in the last 10 years. I put a PE and price of free cash flow in 10 years of 17, 20, and 23. And again, my 9% no margin of safety return. Analyze button. All right, not terrible. A low price of 105 to 111, high price of 200, middle price of 150. All right, so maybe without any margin of safety, we're at where we should be. So if I change this to 10, 11, and 12. Maybe I'm interested. I have it on my watch list under 140 to sell puts, but it's pretty close to there. I'd probably sell puts at 130 or below. Okay, not bad. Not bad at all. Stock number 3, Zoom Communications. Guys, I think I read that Zoom does 300 million active has 300 million active users using their software today. Before COVID, it was 10 million. This is a company that surged because of COVID and held on to it. We look at it now going, we always sit there and say, let's do a Zoom. Let's do a Zoom. It's almost becoming a verb, Zoom me, something like that. It's just like unbelievable how this company's done. But look at the stock price. COVID, all-time high, $588.84 on October 19th, 2020. It's currently at $60. It hit a low of $58 just back in October, which would have been a literal 90% fall. That's incredible. Price to free cash flow is low, 13. Wow. This is what I love, guys. Look at this. Net income last year, $640 million, $1.5 billion in free cash flow. 5-year net income, $560, 5-year free cash flow, 1.1. So they're reporting more free cash flow than net income. Me likey. Gross profit, 76%. Makes sense. Okay, let's see where their revenue is going because I really want to see what's going on here. Good God, people. Look at this. 60 million, 150, 330, 620, 2.6 billion, 4.1, 4.4, 4.5. So not a lot of growth here, guys. Not a lot of growth here in the last few years. Not a lot of growth. Let's see. What do analysts think here? EPS, my God, look at this terrible, basically flat for the next 5 years, 6 years, with revenue growing 3 to 4%. Wow, not a grower at all. 8 pillars. Oh, wow, look at those shares outstanding. They're diluting people, folks. Let's see if they're still diluting people. We go to the income statement, go all the way to the bottom. Yeah, they're adding a few shares every year. 258, 233, 283, 296, 296, 300. Yeah, so they're adding shares. I don't like that very much. Let's see when I did it last. May of 2023. The revenue growth, I put 3, 6, and yeah, I made really high assumptions here. But I put 13, 16, and 19% for my desired returns. I did 3, 6, and 9% revenue growth. Let's alter that to 2, 3.5, and 5. Profit margin, 10, 15, and 20. Free cash flow, 20. Yep, I'm fine with free cash flow, 20, 28, and 36. PE, 15, 18, and 21. Okay, not bad. Yeah, so I'm looking at this going, on my watch is at 50. My middle price on the free cash flow is $45. Okay, getting me a good 16% return. Guys, please click the link below. Sign up for $7 for 7 days before the waitlist starts on our software. It'll change your view of money. Take care.